This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil. Welcome back to the channel. I've been providing technical stock research and consulting to institutional money managers for about 35 years. The reason why I'm bringing that up is that I got a question regarding the volatility from one of my subscribers, actually, and he went back and looked at high volatility period back in the 90s. And how the market continued to go up. So I'm going to spend a little time going back historically and talk about this because I think it will help you guys to understand at least kind of where we are and how I think it's relevant to what took place in the 90s, how it's different, but how we might want to adjust our current approach. All right. Now, anyone who is new to the channel, I suggest you subscribe. I do videos on Tuesdays and Fridays. On Tuesday, I do a video on techniques, MACD, ADX, using multiple time frames, understanding technical analysis. And Friday, I do a market update. All right. Now, also want to mention that if you're interested in learning more about these techniques, you can go to rabilstockresearch.com/book, and you can get more information on this book that I'm offering at a discount right now. Okay, I do want to start out with the market conditions, just run through those first, and then we're going to start talking about each individual indicator. In terms of the sentiment, there really wasn't a big change. It dropped just fractionally, a few less bulls, a few more bears, and it was very fractional difference. Doesn't really change much. It's sort of easing off the negative, meaning getting too bullish, but not in a rapid fashion or anything like that. Now, we did get a push up in the RSI 5 for the weekly. It's up to 76 here. So we're back into square negative, basically overbought again. Now, I did mention this last time. We do have potential divergence here. Now, in terms of like a trading play, there was a potential pinch play to the downside. That was a divergent pinch that if you only traded off the weekly, like if you just did a pinch play off the weekly, it would have turned into a loss. This is the reason why, and I talk about this in the book, I use a 2 time frame pinch play, and it would have prevented, if you do that, if you go down an extra time frame, it would have prevented this kind of a loss. So we're still looking for this is potential divergence. So we're looking for signs of deterioration or a real sign of distribution. We haven't quite seen it yet. Now, the volatility on the daily has come back down. I'm going to go through that in a second, and then I'm going to spend a lot of time on the weekly volatility, which is right now turning to the upside. You can see that the average true range is moving up above its moving average. Okay, just like back here, it was turning down below. That was a good sign. That's a bullish sign. This is something that we need to. It's sort of a warning flare off the bow. We have to be a little bit more concerned if it persists. If we were to continue to go higher here, and this were to drop off, then no big deal. But we want to be on our toes right now. All right. Now, in terms of the trends on monthly, weekly, both the trend and the momentum are in good shape. On the daily, we have a positive trend, but I still consider the ADX too weak to put that in the positive camp. I'm at neutral there, even though we got a crossover on the daily MACD. All right, so that gives an update. I know people like to go and do their own spreadsheet and then kind of compare to what I'm doing. I think that's a great idea since I've been keeping this up on Fridays for quite some time now. All right, let's look at these. And what I'm going to do, I'm going to just spend a minute. I want to go through and historically look at what's taken place. Now, what I've done on here is I've got an 18 MA, right? That's this magenta colored line like I have on all, but I don't have the 40 up. I just have the 18. So the 72 week is an 18-month line. All right. If you were to put an 18-month line or a 72 week up, they're basically the same thing. You're going to get a lot of the same readings off that. And then not quite as accurate, but pretty close is the 360 moving average on a weekly, which is essentially the 18 on a quarterly chart. All right. Now you can see these shifts taking place in volatility and this isn't really early. This isn't really that confirmed yet until we make another high here, but we are seeing signs of a shift just like we did here. That was concerning, mainly because we were kind of stretched away from the 18-month line. When we get stretched away, we want to look for a volatility increase, okay? So we want to go back. Now, this indicator isn't the end-all, be-all. I don't want to give you the impression that, if this is doing one thing, you got to follow. I mean, it's not like that. You can't take any indicator that way. I mean, there are times when ADX is just flat out wrong, and you have to know when that's going to be the case. Now, here's what I wanted to point out. We've got this move in the 90s, all right, basically from the mid 90s on, where we had a pretty strong uptrend in place and volatility on balance was moving higher. Now, the point I wanted to make, and what I told my subscriber who asked about this, because he's like, I don't know if this is all that important, is that this was not an easy period to be a trader. Okay, when you look back, you could have bought it here and you just ignore it and just in the end, it was okay until it got up to here, right? But it's not that easy when you're trying to trade. And so I know for a fact, I managed a hedge fund in 99. So in 99, we started a hedge fund and it was a relative hedge fund, meaning we got paid on the difference between how we did versus the market. Well, in 1999, the market was up 40%. Not a great year to start a hedge fund, right? If you're trying to compare yourself. So we only got paid on the difference above the S&P. Well, we were up 90 for the year. So it ended up being a really good year for us. But I want to tell you that it wasn't as simple as buying a bunch of stocks and holding for the year. We were trading like crazy. I don't think I left my desk from, 9:30 to 4 on, more than a couple days the whole year. I was sitting in front of my desk and we were trading. It was pretty active and we were taking profits. If we had a stock that made a move for us, we were just exiting the whole thing. The volatility was very high. Living through pullbacks was not a good idea. That's kind of the idea behind my third course, which is, discussing if we have an increasing volatility scenario, you want to do some altering of your thinking. You don't just want to keep doing things the same way as when you have a low volatility period like this. So this was a beautiful low volatility period, trending to the upside, okay? You could have been in and you could trail a stop in stocks and you'd be fine. Now, if you're in back here, a lot of my subscribers in some of these longer term plays, you're probably still in them, but you're trailing a stop and you've been taking profits. I would think that most of your stops are at a profit. And I would also think that you've taken a couple targets in any longer term plays that you've been in. But in terms of like new buying right now, you see how far we are from the 18-month line. The volatility is starting to increase a little bit. So you got to be a little bit more careful if you're looking to put new money to work on long-term trades. All right. Because the problem is that just like we saw back in the 90s, you can get these big downdrafts. Big downdrafts towards the 18-month line. Let me see if I can reset this. I moved that a little too quick. Okay. So if you notice, we came down to the 18-month, at least close to it, numerous times along the way. And, this was clearly showing some, this was actually a pretty good sign that things were improving. But then we had this period where it was kind of like flat and sideways. And yeah, we had a move, but look at these drawdowns along the way. This was not an easy period to just put money in. Now, that was also the internet period where you could have been in some of these internet stocks and they were flying and stuff like that. And we certainly did a lot of that, but we were trading. We weren't holding through pullbacks. And that's the key thing I want to get across. When we're in a period like this, I think you got to be a little bit more hesitant if you're playing stocks that look like the market or leading the market, like in tech and stuff. You got to be a little bit more careful about living through pullbacks or drawdowns. If we end up breaking the 18-week, there's definitely some risk in here, okay, with the rising volatility that we've got taking place. Now, we might not break the 18-week. It might continue to hold like it has. And if that's the case, I think you can still play the game. But I would probably be playing for quicker targets, maybe with smaller size, that type of thing. Now, on a shorter term basis, the momentum, the average true range has dropped here. All right. We had a drop in the average true range moving average, and it's still declining, even though it popped above. Nothing has really changed here, and now we're starting to drop back down again. Both of these time frames have given RSI buy signals. If you don't know what an RSI buy signal, my suggestion is go and do a search in my channel, and I've done about 4 or 5 videos on this RSI signal, how to use it, how it can be a nice added influence on what you're doing with the MACD and the ADX. But the fact that both of these time frames are offering buy signals right now, and the volatility has dropped off on this time frame, at least right now, then I think it's okay to probably play for shorter term trading. But I think you have to take the whole picture into account. Recognize that this is probably not a time to just go hog wild, making a whole bunch of new purchases and being loaded with no cash in your portfolio or anything like that. I don't know that that's the smartest thing to do. If I'm a trader, I'm probably being a little bit more selective, being a little bit more picky, making sure I get good entries on anything that I'm looking at. All right. I do want to spend a minute going through the different trends, especially because I got a question this week related to MACD and the really the ADX, and the fact that, okay, so we've got this move here, right? And we had confirmation to the upside, and then we went through this bear market, and now we're all the way at new highs. Okay, but this is way down below, and this hasn't gotten above 25. So is that bearish? All right. Now, what I do is I basically I look at this as a reset. So I don't like to compare from that far away. When these are this far away, I don't really want to compare them. I certainly don't want to do it when they're that far away. The perfect window, or the highest probability window for divergence, is usually somewhere in around 8 to 12 bars is probably the highest probability. Sometimes it can go out to 15 bars. But when you get this far apart, it's just, you shouldn't be comparing the MACD from here to there, or from here back to here, or anything like that. All right. What I do is, when we've had a move in MACD and it's dropped all the way down in the area of the zero line. Now, it didn't come down and touch zero or undercut zero or anything like that, but look at how far of a drop it made, and it dropped down below the prior low. I mean, we had a pretty significant drop there. From that point on, I'm resetting. And when I say reset, I'm saying I am not comparing from anything in this direction anymore. I'm starting here, and I'm making a move to the upside. I get a pullback and then a new high. And I'm looking at price, and I'm doing the same thing. And if we go up and make a higher high, I want this to make a higher high. And if it doesn't, then I have divergence. You see what I mean? I'm going to compare from this line going forward, not going back. And I think if you use that strategy in stocks too, I think this will really help you. Now, the same thing goes for the DI. So here's green DI dropping, but look at what's happened since this turn, since we started to turn back up. We made we actually made a clearly higher high here, pulled back, made another higher high here. Now we're making a new high right now, and it doesn't really qualify as a pivot. If you've taken my course, you know that isn't officially a pivot high. So we don't really have that as a pivot, but it is kind of lingering off. It's dropping off a little bit, but notice how there's no selling strength at all. So I don't view this as all that glaring or something that would bother me. I do want to point out that when we have a reset, we just keep comparing and going. And right now, I think because this isn't a true pivot, I don't know that I would be overly consumed about this is a big divergence developing. MACD is clearly making new highs with price on this time frame. All right, I wanted to clear that up and make sure everybody understands that. I think it'll be helpful, especially when you're analyzing your individual stocks. Okay, so we do have this window that we don't like developing in both DI and in MACD. Now, I mentioned this last week, and I said, hey, we got a narrow range bar here. We went to a new high. This is not above its signal line. We should be maybe looking for a move back down into this zone in here. All right. But we want to use the smaller time frame to help with that. I don't like to take trades off the one. So I'm not a huge fan of taking a pinch play setup by itself. I typically don't. Now, the only time I will do that sometimes is when the ADX is really in agreement rivet. I mean, this is a powerful trend we're dealing with. So to play counter to that, you see what I'm saying? Like, this would be playing counter to this. I don't really want to do that in a single time frame. If I'm going to do it, I need support from the smaller time frame, because I know I'm playing with fire a little bit. I've got a strong trend, and I really don't want to be messing with that strong trend unless I do it on a shorter term time frame where I can get in and get out more quickly. Well, the daily really didn't set up that well, right? It came down as we were looking for. It broke the moving average, came down, and then instead of forming a pinch here, it just rallied straight back up and never took out a bottom. You see how this has not taken a bottom out? And then we had a big bottoming bar at the low as well. Not really what you'd expect if this is getting ready to make another move to the downside and make a test. Now, it doesn't mean it can't happen, going forward. It's possible we could get another, we're still operating on a potential divergence here, because we're at another new high, and this is not, it's not confirming, and ADX is kind of low. So this is my real problem with, and this is the reason why it's neutral, is I don't like the fact that the ADX hasn't made a new high, but more important to the near term is the fact that the green DI, which is the strength of the buyers, hasn't been able to get back above 25, even though we've made a move, pretty substantial move, and up 5-6 days, and we're at a new high. All right. So you just have to understand where I'm coming from on this. This is neutral. It's not bearish, because we're still above the zero line. We've still got an uptrend in place, and the sellers are not strong. I can't call this negative. It's not really bearish. It's just not as bullish as it could be. So just got to be a little bit more careful. And like I was talking about earlier, when we have a trend in place, you don't necessarily want to get overly bearish, but you got to get a little bit more careful about your entries when the volatility is going up and or the momentum is dying out, right? And so we just got to be a little bit more selective with any new entries. All right, let me know if you have any questions, and we'll see you next time.